Diamonds. The finance internet has a side hustle problem. Every week, there's a new video telling you to start a dropshipping store, flip items on eBay, build a faceless YouTube channel, or do print on demand. And the people making those videos are making their money from the videos, not from the side hustles they're selling you. Meanwhile, the people who are quietly building real wealth are doing 10 things that are so boring they never go viral. Not because they're secrets, because nobody wants to watch a video about them. Here's what the research actually shows. A study from the National Bureau of Economic Research found that the single strongest predictor of long-term wealth accumulation is not income level, not investment return, and not entrepreneurial activity. It's the savings rate, the percentage of income that's invested rather than spent. And the savings rate is shaped almost entirely by habits, not by intelligence, luck, or any particular money-making strategy. These aren't hacks, they're habits. And the math behind each one is what makes them powerful. Habit 1. They automate savings before they touch their paycheck. And for the single most reliable predictor of whether someone saves consistently is not discipline, it's whether saving is the default. When your paycheck hits and you have to manually transfer money to savings, your brain registers that money as spendable. You spend it. However, behavioral economics study on savings confirms this. Humans are terrible at saving out of surplus. We are very good at living on what we have. Finance researcher Shlomo Benartzi at UCLA studied retirement savings behavior across thousands of employees and found that workers who were automatically enrolled in 401k plans, where the default was participation, had participation rates above 90%. Workers who had to opt in had participation rates around 40%. Same offer, same benefits, dramatically different outcomes. Plus a minus, the only difference was whether saving was the default or the exception. Comments: the people who build wealth do not give themselves the choice. They set up an automatic transfer to their investment account on payday, or better, they max their 401k contribution at work, so the money never hits their checking account at all. You can't spend what you never see. This one habit, executed consistently, is worth more over a lifetime than most side hustles will ever generate. Habit 2. They treat their net worth like a scoreboard. Most people know their income. Almost nobody tracks their net worth. Net worth, assets minus liabilities, is the actual number that tells you whether you're building wealth or just earning money. A person making $120,000 a year with $200,000 in debt is worth less than a person making $55,000 a year with no debt and $80,000 invested. It is simple. Once a month, calculate your net worth. Add up what you own, investment accounts, home equity, savings, vehicles at current value. Subtract what you owe, mortgage balance, student loans, car loans, credit cards, personal loans. Write down the number. Watch it move. Finance. The act of tracking a number changes your behavior around that number. Researchers call this the Hawthorne effect. When we measure something, we start optimizing for it. You'll make better decisions when your net worth is a number you look at regularly. A study published in the Journal of Financial Planning found that households that tracked net worth quarterly accumulated significantly more wealth over a 10-year period than households with similar incomes who didn't track it. Habit 3. They never let lifestyle inflate with income. This is the one that destroys more wealth-building trajectories than anything else. You get a raise, you sign a nicer lease. You get promoted, you buy a new car. The income goes up, the spending immediately follows. This is lifestyle inflation, and it's the financial equivalent of running on a treadmill. Your income doubles but your savings rate stays flat because your expenses doubled too. Economists call this the income consumption elasticity problem. Every $1,000 increase in monthly income tends to produce $800 to $950 in new spending within 18 months, leaving almost nothing extra for wealth building. The wealthy habit is to let income increases flow disproportionately into wealth, not lifestyle. The trick: allow yourself to enjoy a portion of the raise, say 30%, while committing the other 70% to investment. A $1,000 per month raise that sends $700 to your brokerage account and $300 to lifestyle improvements is sustainable because it gives you something and still builds wealth aggressively. But a hard constraint with no reward is one you'll eventually break. Habit 4. They know the real cost of housing before they commit. Housing is the single largest financial decision most people make, and the conventional wisdom that renting is throwing money away is demonstrably wrong in many markets. The New York Times has a rent versus buy calculator that accounts for the full cost of ownership. Most people who run their actual numbers are surprised. Total costs of homeownership beyond the mortgage. Property taxes, typically 1 to 1.5% of home value annually. Homeowners insurance, with $200 to $3,000 per year depending on market, maintenance and repairs. Budget 1 to 2% of home value per year. On a $400,000 home, that's $4,000 to $8,000 annually. HOA fees if applicable, and transaction costs of 5 to 8% to sell. Diamonds. The people who build real wealth through homeownership buy the right home at the right time in the right market, not because they were told renting is wasteful. Habit 5. They max their Roth IRA every single year. Minus the Roth IRA is the single most underused wealth-building tool available to American workers under the income limits. In 2025, you can contribute $7,000 per year, $8,000 if you're 50 or older. The money grows completely tax-free. Unpay taxes now at your current rate, but every dollar of growth, every dividend reinvested, every capital gain compounds without the IRS taking a single dollar. 25-year timeline. A maxed Roth IRA at 10% annual return can produce over $750,000 in completely tax-free wealth. If you're in the 22% tax bracket in retirement, the Roth effectively pays you a 22% guaranteed return simply by eliminating the tax bill before a single investment return is considered. And treat the Roth IRA contribution like a bill. It's $583 a month. And to schedule it January 1 of each year if possible. Front-loading the Roth so your full contribution is invested on day 1 of the year, rather than spread across the year, adds tens of thousands of dollars over a career purely from the extra months of compounding. Habit 6. They don't try to time the market. Research from JP Morgan covering the last 20 years shows that if you missed just the 10 best trading days over 2 decades, your returns drop from 9.8% annually to 5.6%, 10 days. If you miss the 20 best days, you drop to 2%. Hence, the market's best days cluster directly around its worst days, during and immediately after crashes, when fear is highest. The investor who sold in March 2020 and waited to feel safe missed a 50% recovery. The investor who sold in 2022 and waited for confirmation that the market had bottomed missed the 24% rally in 2023. The evidence is not subtle. The cost of trying to avoid the bad days by timing the market is losing the best days. Hence the boring habit. Stay in, don't sell. Set up automatic investments and let the system run without emotional override. People who do this don't feel clever. They feel boring. But the math rewards boring people with dramatically higher terminal wealth than the clever market timers. On 7, they never finance depreciating assets. A car loan at 7% on a vehicle that loses 15% of its value per year is one of the most reliable ways to stay exactly where you are financially. You're paying interest on an asset that's getting cheaper every month. After 5 years of car payments on a vehicle bought new, you own something worth approximately 40% of what you originally borrowed, having paid the full purchase price plus thousands in interest. A wealthy habit. Buy used vehicles with cash or on short loans at low rates. Drive them for 7 to 10 years. That's the difference between someone who buys a new $45,000 car every 3 years and someone who buys a 3-year-old car for $22,000 every 8 years is not just the monthly payment, it's the invested difference. That monthly difference, invested at 9% annual return over a career, exceeds $500,000 in terminal wealth. At 8. They automate bill pay to protect their credit score. And credit score affects your interest rate on every mortgage, every car loan, every line of business credit you'll ever need. The gap between a 760 credit score and a 680 credit score on a 30-year mortgage can be a full percentage point in interest rate. On your maintenance on a $400,000 home, that 1% difference costs approximately $85,000 in total interest over the life of the loan. That's an $85,000 wealth destruction event that starts with a few missed payments. The single most reliable predictor of a strong credit score is on-time payment history, which accounts for 35% of the VICO score calculation. The boring habit. Automate every bill you can. Not the minimums on credit cards, the full balance. Set auto pay to clear the card every month, so you're never carrying debt and never missing a payment due to forgetfulness. Most people don't realize that credit scores also directly affect insurance premiums, not just mortgage rates. Auto insurance and homeowners insurance premiums in most states are credit score dependent. A driver with a 680 credit score pays approximately 40 to 50% more in auto insurance than a driver with a 760, according to data from Bankrate and Value Penguin. On an average annual auto insurance premium of $1,500, that's a $720 difference per year, just for driving the same car with the same accident history. Over 40 years, that $720 annual difference invested at 9% annual return becomes approximately $314,000 in terminal wealth, destroyed entirely by a credit score that never got prioritized. The same relationship holds for homeowners insurance. The lower your credit score, the higher your premium in most states. People who manage their credit obsessively aren't just saving on mortgage rates, they're saving on every insured asset they own for the rest of their lives. Habit 9. They maintain 6 months of expenses in a high-yield savings account. An emergency fund sounds obvious. Almost nobody has one at the right size. The Federal Reserve's annual report on household economics consistently finds that a large percentage of American households cannot cover a $400 emergency without borrowing. And the result? A car repair, a medical bill, a job loss forces people into high-interest debt that can take years to escape, derailing the entire wealth-building trajectory. 6 months of expenses is the target. If your monthly costs are $4,500, you need $27,000 in a savings account that earns something. High-yield savings accounts at online banks currently pay 4 to 5% annually. Your emergency fund earns $1,080 to $1,350 per year. Just sitting there, available if needed, working while you wait. This isn't a missed investment opportunity. It's the insurance policy that keeps every other investment intact by preventing emergency debt. Here's the spiral that happens without it, and it's worth walking through in detail. The average unexpected expense that Americans carry on a credit card is approximately $5,500. Let's put that on a card at 22% APR and carry it for 18 months, which is what most people do when they have no emergency fund, and you pay approximately $280 in interest. That's the easy part of the story. The harder part is what the research shows about debt's effect on financial behavior. A study published in Psychological Science found that financial anxiety caused by carrying debt measurably reduces cognitive bandwidth, your brain's capacity for planning and decision-making. People carrying high-interest debt are statistically less likely to maintain 401k contribution rates, more likely to reduce investment contributions during market downturns, and more likely to make short-term financial decisions that undermine long-term goals. The $280 in interest isn't what's really destroying wealth. It's the reduced 401k contribution that debt anxiety triggers, the month you drop your contribution from 10% to 3%, because the $400 minimum payment feels crushing. That single behavioral change, over a 20-year accumulation period, can cost far more than the original emergency expense ever did. The emergency fund doesn't just prevent debt. It protects your entire investment behavior from the psychological damage debt causes. At 10, they review their biggest expenses once a year, ruthlessly. Not every subscription, not every latte, the big ones. Housing, transportation, food, insurance. These 4 categories represent 60 to 70% of most American household budgets. A 10% reduction in your housing costs is worth 20 times more than eliminating every streaming service you own. Once a year, pull out your last 3 months of bank and credit card statements and identify every expense over $100. Look at your top 10 recurring items. For each one, ask a single question. Is this giving me value proportional to what it costs? Or has this just been on autopay so long I've stopped noticing it? Conversation with your insurance provider, your internet company, your landlord at renewal time, can save you hundreds to thousands of dollars per year that flow directly into your investment account. The people who never have this conversation pay a permanent premium for their inattention. None of these 10 habits are exciting. None of them will get you 1 million subscribers on YouTube. But every single one of them has more empirical evidence behind it than any side hustle. And the people quietly executing on these habits are building wealth in a way that most people will look back on and wish they'd started earlier. What's the one habit from this list you're already doing? Drop it in the comments. And which one have you been avoiding? I want to see both answers. The combination usually tells me exactly where someone is in their financial journey. And if this gave you something concrete to act on today, share it with one person who needs it, and subscribe. Next week, we're breaking down the exact dividend stocks that pay your bills every single month, with the data behind building a reliable passive income stream from zero.